Let's take a look at your money in the morning on the first trading day of August. A busy day of earnings on deck. Caterpillar, JetBlue, Uber, all reporting second quarter earnings before the bell this morning. Starbucks is going to be reporting after the bell today. We're also looking ahead to Apple and Amazon. That is Thursday. Joining me now is Vettafi Vice Chairman Tom Lydon. Tom, it's good to see you as always. Let's talk about earnings here. You know, lowered expectations in a general sense here. Most companies have been beating on lowered expectations. Is that enough for you right now?
Well, they've been consistent. They have been beating. So far, year to date, we've seen 78% of stocks beating estimates, and I think that's going to continue, Cheryl. And when you look at companies like Caterpillar that crushed their earnings estimate in the first quarter, you got to be optimistic that we're going to see more of the same. Dealer inventory's down, estimates are high, and they're also benefiting from the infrastructure bill. So things look very bullish for Caterpillar right now. As far as Uber and Starbucks, more of the same. People are spending more money on the road. There are also consumer numbers for Starbucks look really good, especially increased opportunities over in China.
Yeah, we're probably going to get Caterpillar in the next few minutes. I do want to say that the estimates, they're looking at the estimate is about a 44% earnings per share surge. That's a year-over-year comparison, which would be very strong for Caterpillar. Now, it's not just about earnings right now. This is a big week for jobs data. We've got the June Jolts report. That's at 10 a.m. Eastern time today. Economists expecting over 9.6 million jobs opening, but that number has been falling, to be clear here. We also are going to get July ADP. That's tomorrow at 8:15. Claims on Thursday, the July jobs report on Friday. Tom, what is most important to you out of the four things I just listed?
Well, I think they're all important, Cheryl, but the biggest thing is wage numbers. We're seeing wage numbers increase at an amount that's greater than the inflation rate. That's really concerning for the Fed. Getting wage numbers under control will be important. Again, it's nice when consumers and workers are making more money, but that's just going to fuel inflation that much more, which will extend the Fed hiking interest rates. So they're looking all over the place to try to get things under control. Unemployment numbers are at 50-year lows right now. So things are really good for the economy, but most importantly, the Fed's looking to bring this in for a soft landing.
Well, I think wages is the one weak data point that we've continued to see under the Biden administration. In fact, wages have been falling as we've been dealing with at some points sky-high inflation, and inflation still is high. 3% is no picnic for anybody out there. But, you know, the market discussion is certainly about, you know, where to put your money, especially now because we had such a strong first 6 months of the year. The Wall Street Journal writes that the benefit of owning stocks over bonds keeps shrinking as some worry the rally is unsustainable after a gauge of stocks' relative value falls to a 2-decade low. Tom, do you agree with that?
Well, there's a calculation, the equity risk premium, which is really the benefit of owning stocks over bonds. And they're saying the benefit right now is bonds. And there's a couple reasons. Number one, rates are higher, the highest they've been in a long period of time. So you're getting paid more. However, most financial advisors believe a year from now, rates will be lower. We may be in a slight recession. The Fed will be forced to cut rates. So that means that you're not going to get the same yield that you will today. And on top of that, from a valuation standpoint, you look outside the top 10 stocks in the S&P 500, and rates are realistic. They're in line with historical numbers. And most importantly, small caps, the Russell 2000, beat the large caps over time, and they're relatively cheap compared to large caps right now, almost 40% less with a PE of 11. So look to small caps continuing to catch up with large caps. They've outperformed the last 3 months, and we're seeing this trend continue.
All right, Francis, jump into this conversation.
Hey, good morning, Tom. So we've had an inflection in commodity prices, which is going to have a lagging effect on CPI, but we've also had an inflection in bankruptcies, foreclosures, and delinquencies. So when you think about where the Fed is going and where rates are going, what do you think weighs there? What do you think is the bigger risk, and how do you trade it?
Yeah, foreclosures, delinquencies, that's a number to keep an eye on. Another number that we've seen recently is car loan denials as far as applications spiking up to 10%. So again, at one point in time, things have got to slow down, and you're going to start seeing a little bit more of that. However, if we can get a soft landing, and that's really what the Fed is looking for, and that's what most financial advisors, when you survey them now, they're less concerned about a recession, more concerned about market volatility, still not concerned about inflation, as the Fed, in their mind, is seemingly doing a very, very good job.
All right, Tom Lydon, it's interesting you bring that up because Brian Moynihan, the CEO of Bank of America, was here last week, and he said the same thing. He said soft landing, recession. He said, there's more discussion on his side about a soft landing, which is, I think, a good thing. Tom, it's good to see you. Thanks for being here.
Thanks, Cheryl.
All right.